all, welcome to my channel. My name is Prajakta Bapat. Today's topic is ratio analysis and interpretation. Let us understand first what are ratios. So ratio is a relationship between two numericals or two numbers or two variables. Now, how it helps in financial statements? So it helps to analyze financial statement. It helps us to know company's financial position or performance of company. There are three types of ratios. First is balance sheet ratio, second is income statement ratio, and third one is combined ratio. Now, balance sheet ratio, why it is called as balance sheet ratio? Because the two variables which we are considering for calculation of ratios that are considered from the balance sheet itself. For example, if I take capital and if I take assets, both items are from balance sheet. That's why it is considered as a balance sheet ratio. Income statement ratio meaning the two variables which I am considering that are from income statement. So for example, you may take gross profit and sales, or you may take some expenses to sales. It will be considered as a income statement ratio. Next is combined ratio. Combined ratio meaning obviously one item from balance sheet, one item from income statement will be taken. So for example, if I take assets and if I take sales, it will be considered as a combined ratio. Next is forms of ratio. Forms of ratio meaning how ratios are expressed. So first is pure ratio. We often see sometimes ratios are expressed in percentage or sometimes in proportion. So these are three which I have noted down here. First is pure ratio, meaning it is a simple division of one number by the another. Okay, percentage meaning they are expressed in percentage, and rate meaning sometimes they are expressed in rate, for example number of times, number of days. Likewise, we'll be seeing examples of this in next part of the video. So these are broad 5 categories of the ratios. These ratios are classified into 5 categories according to its functions. So for example, meaning what they indicate. So for example, liquidity ratio. So they indicate short-term liability, short-term position of the company, short-term financial position of the company, or you can say short-term solvency of the company. If I say profitability, it shows how much company is profitable at current state. Then capital structure, it shows combination of debt and equity. Likewise. So in every video, we'll be discussing each categories of ratios. So in this video, we'll be discussing about liquidity ratio. Now what is liquidity ratio? So liquidity ratio is basically which, now first let us understand what is liquidity. Okay, liquidity is the position of company to pay short-term liabilities. So when I say liquid, how far a company is having liquidity position, that means how far they have cash or assets which are easily convertible into cash. So all assets which are easily convertible into cash like bills receivable, debtors, cash, fixed deposit with bank or bank balance, these are called as liquid assets. So liquid ratio shows that how far a company is having current assets to pay off all their current liabilities. Okay, so we'll be discussing here two ratios. First is current ratio and another one is liquid ratio. Now what is current ratio? Current ratio meaning which shows the proportion between, or a relationship between current assets and current liabilities. So current assets, we all know current assets and current liability are for a shorter period. It has a validity of only up to 12 months. Okay, it does not exceed 12 months, right? And which includes debtors, prepaid expenses, or bills receivable, etc. in current assets. And current liabilities, for example, it includes outstanding expenses, creditors, bills payable, etc. So it is one of the pure ratio. Okay, and a standard ratio is 2:1. That means ideally company should have twice of current assets than current liabilities. This is current ratio. Next is liquid ratio. Now liquid ratio is also called as quick ratio or acid test ratio. Now here I will be considering proportion of liquid assets and liquid liabilities. When I say current assets or current liabilities, it is a broader term. okay, which includes liquid, that is quick, and non-quick assets, as well as same for liabilities. But when I say liquid ratio, it focuses only on liquid assets, that is quick assets and quick liabilities. Now what is quick and non-quick? So quick are which are easily convertible into cash or quickly convertible into cash, and non-quick meaning which are not easily convertible into cash. So here I want to focus only on quick assets and quick liabilities. So your formula is quick assets upon quick liabilities. Now how to get those quick assets and quick liabilities? So if you see numerator, it is current assets, that is CA, minus closing stock minus prepaid expenses. Now why I have deducted this 2 from current assets? So as I said, current asset is a broader term which include quick as well as non-quick. But here I want only quick assets. So what I'm doing is from current assets, I'm deducting non-quick assets. Okay, so these two are closing stock and prepaid expenses are non-quick assets. Okay, now why that are termed as non-quick assets, let me tell you quickly. Because closing stock is the stock which is lying at my godown. Okay, I may be in a position to sell it, but if there is no demand in the market, I won't be forcefully selling it out, right? So it cannot be easily convertible into cash. And prepaid expenses meaning you have paid in advance to somebody. So as you have paid in advance, you cannot get it back easily. So again, it is not convertible into cash easily. So that these two are non-quick assets. So I am deducting it from current assets so that I will get automatically quick assets. Okay, upon same for liabilities as well. Current liabilities minus bank overdraft minus income received in advance. These two will be deducted from current liabilities in order to get quick liabilities. Okay, these two are non-quick liabilities which will be deducted so that you get current liabilities. So final formula is quick assets upon quick liabilities. And standard ratio for this is, again, this is one of the pure ratio. Standard ratio is 1 is to 1, meaning ideally company should have equal liquid assets to equal liabilities, to liquid liabilities. That's it for the liquidity category. Okay, thank you for watching this video. Next category we'll be discussing in the next video. Okay, if you like my videos, kindly share and subscribe.